Thank you for, we have a special guest for today, and his name is Daniel. He is in charge of our business development department, and he will be doing the car buying presentation for us today. And then we're kind of mixing things in. So we're going to also have a little session on credit to make up for last week. So if you have any questions at all, please ask us. You can do so in the chat, or you can take yourself off mute. So from here, I will let Daniel take it away.
Great, thank you. Give me just a second. All right. So this is a small group. So if you have questions, you want to go ahead and ask something while we're presenting, that'll be fine. Just maybe put it into the chat. I think, Alita, do you have everybody muted?
Yes, everyone can mute and unmute themselves.
Okay, so if you do want to stop me, it's a small enough group that I think we can do that. So if you have questions along the way, you want to ask something or something's not clear, just go ahead and ask, it'll be fine. And if you want to follow up with this later, my contact information is in this presentation. I know it's being recorded, but both Daisy and Alita have probably shared their information with you as well, and we can go ahead and answer any questions or maybe follow up with you if you'd like to talk privately about something or about this process of buying a car. And car buying is really interrelated with credit, so that's an important part of this presentation. And so Alita will be talking about that as we get deeper into the presentation itself. But like I said, any questions, raise a hand, go ahead and unmute yourself or ask. We'd be happy to go ahead and answer those things for you. So first thing is just buying a car is probably going to be one of the biggest expenses or the biggest purchases you're going to make personally. I mean, for most people, it's either a house or a car. So this is going to be something that's important for you, especially if this is your first car. And if it's not your first car, maybe you had a great experience the first time, maybe you had a bad experience. And if you want to share any of that with us, you can. We're hoping that we can answer questions about things that you might encounter as you go through this process. And we want it to be something that's both exciting for you because you're getting your own car, but we also want it to be something where you get the best deal and you feel reassured that the decision you made was the right one. And so those are the things that are important. So how do you feel when you buy a car? I mean, most people are excited, they're happy, and at the same time, they can be both nervous and stressed because there's a lot of decisions you're making, like what kind of car, features that you want. Should you get a new car, a used car? Should you lease or purchase? I'll bring up something right now that's kind of relevant, the fact that because of the pandemic, there was a shortage of computer chips. So you may be noticing that car prices have actually gone up. And I've talked to some dealerships who've said that they're expecting that a shortage of cars is going to go on for maybe as long as 3 more months. So all of these things are going to impact your decision and this whole process for you. So they're things that you should be aware of. And like I said, a car is one of the biggest purchases you're going to make in your life. So thinking about it, planning, getting help, those are all going to make it a much better experience. And we hope this presentation is going to help you with that. So there are a lot of reasons to get a new car. One may be that if you have an old car or used car, repair costs are significant. So if you don't have something that's reliable, that could affect you financially. The car may be unreliable, or it may not have safety features. I mean, that's a big or important factor right now is the newer cars, even cars that are 10 years old, have so many more features than the older cars. I mean, there's safety, there's things like assistance with parking. There's all kinds of things that come into play. You may also want to get a new car because it no longer meets your needs. And maybe you have like a family, maybe you've got kids, maybe you need something that's more reliable when it comes to going on long trips or maybe out in the country or something like that. So you want to find something that's appropriate. You may just want to get something that's new too. I mean, at a certain point, you may just get tired of the car you have and you want to go ahead and move on to something new, and that's fine too. Over time, all of your needs are going to change, all of your desires or what it is that you want are going to change, and that's fine. But so the process is really important. So what car should you get? There's lots of considerations when it comes to needs versus what you want versus the safety and reliability of the car as well as your budget. Think about things like, do you need to carry a lot of passengers or haul things? Could it be for work or recreation? Do you want something that has good performance? And by performance, I don't mean something that, you're just going to race around in it. I mean, you may want a car that's just something that you can rely on, that looks nice, maybe helps you with your job, but also will perform well so that you're safer in it. You may want to think about things like how important the safety of the car is. There are some cars that are safer than others or more suited to certain types of functions than others. And then finally, it's what we talked about with your budget. And I believe that you've already gone through a budgeting workshop. Alita, have they talked about budgeting already?
Yes, we've talked about some budget.
Okay. So then you've already thought about, what is it that you can really afford to spend? And that's an important factor here when it comes to, what it is that you're going to buy, because you really have to think about how much can you afford? You want to look at your budget. You want to go ahead and figure out what it is that you can purchase based on what you're comfortable with. I mean, in some cases, I'll give you an example. A lender is going to look at a percentage of your income as what they're going to qualify you for when it comes to a car loan. Generally, they're looking at whatever your pay is, they want no more than 15% of your gross income going towards your car payment. So that may be good when it comes to getting an approval, but maybe you're not comfortable with that. Maybe 15% of your income is more than you want to spend on a car. And so you have to go ahead and take into account the other things that you want in life, whether or not you want to spend more maybe on some other things in your budget. And so those are all things that you want to make sure are related to this. There are other factors that come into your budget too. A newer car is going to cost more when it comes to things like insurance and the registration. And so because of that, maybe you don't want a brand new car. Maybe you want to get something that's used but in good shape, that looks nice, and maybe that's a more affordable option for you. If you want to borrow the money for the car, you have a couple of factors that come into play. One is that you need to go ahead and save then for a down payment. You could get 100% financing, but if you do, your payment's going to be higher. So maybe to accommodate your budget, you want to go ahead and save some money, pay down the cost of the car to begin with, and that way have a smaller loan and be able to be comfortable with whatever the payments are. Some of the things you can do to go ahead and save for a down payment are, for instance, setting up a direct deposit. I'm sure Alita probably talked about that. Maybe take a portion of the paycheck that you're going to be getting and make sure that that's dedicated to a savings account that's going to be set aside for you to pay for a car or maybe something else. But at least this way you have some money put aside for something like that, and make it an automatic deduction, not something that you even think about. And that way you'll have the assurance of knowing that money is going into an account. Keep it separate from your regular budget account. It shouldn't be commingled with like the money that you're using to go ahead and pay for groceries, to go ahead and pay for regular expenses like your rent and things like that. I mean, it should be set aside completely separate from everything else, even at a different financial institution. And that way, it'll be available when you need it. Sorry. Some of the advantages of buying new are that you get reliability. I mean, you've got a new car, so you know that it hasn't been mistreated. You know what the maintenance is like. You've probably got a new warranty on it. So that means that it's going to have some assurance for you that if something breaks, especially within a certain period of time, the manufacturer is going to take care of some of those costs for you. You can also customize the car. You can go ahead and talk to the dealership about the type of car that you want, the features that you want. If you want certain safety features, if you want certain performance features. So those are all things that you can kind of add in there. The disadvantages of buying new are it can be very expensive. I mean, cars, I was shocked by some of the car prices right now. Like I said, some of those have come about because we're in this period now where computer chips are in a shortage. And so that's a big part of manufacturing of cars. And so there's a supply shortage. And because of that, prices have gone up. I was looking at a loan that we were doing for a car for a Honda Civic, and you'd think that'd be an affordable car. It was a $50,000 car. So purchase price on a new car can be really expensive. Because it's a new car, your insurance coverage is going to be higher. Older cars, maybe with a little mileage, they're going to be a little less when it comes to your insurance. And then your registration is going to be higher as well. And then the other factor is that you're going to have depreciation. What you're going to have is a loss of the value of your car as soon as you drive it off the lot. Typically what happens is as soon as you get in that car and drive it away, you lose about 10% of the value of the purchase price of the car. In the first year, the average loss is 20%. And every year after that, it's about 15%. So in 5 years, a car you buy for $30,000 is worth about $12,000 to $13,000. So that's something to keep in mind. You have this immediate depreciation is what we call it. The advantages to buying a used car are that you might be able to find something cheaper. So you might be able to purchase it with cash instead of getting financing. Depreciation is going to be less. Like I was saying, with a new car, as soon as it's driven off the lot, I mean, it's lost its new car value. It's been driven, it's been owned. All of that means that it has that depreciation I was talking about, so you lose value to the car. With a used car, it's already gone through that process or started it, so the depreciation is slower. And so you're going to maintain some of the value for a lot longer with the used car than you do with a new car. In some cases, you can get a bigger selection of cars too, because if you're getting something new, you're kind of at the mercy of the dealership and what they're able to acquire for you. You may request certain features and they just may not be available in the cars that they have in their selection. Whereas with used cars, you can kind of scan all of the different dealerships, look at all of the different cars that are available, and you might be able to find something that better fits your needs. Some of the disadvantages of buying used are you don't know the history of the car. I mean, there are services like Carfax, which the credit union offers. So for instance, we offer Carfax on cars. Dealerships generally will offer those as well. Some other services might provide that too. And what a Carfax does is it shows you what's happened to the car, how many owners, if there was any history or records of maintenance. It talks about whether or not the car was in an accident, was a salvage or something like that. Something that maybe isn't evident by just looking at the car when you see it on the lot. So with used cars, you don't necessarily know the history because it's not brand new. There's usually a limited warranty or a soon to expire warranty. If you do want an extended warranty, you're going to have to pay for it or buy it. In some cases, that might be worth it depending on your financial situation. In a lot of cases, I don't know that that's really worth the expense that you're going to put into it. An older car might have higher maintenance costs as well. So, you know, if you're trying to get away from something that's unreliable, this may not solve your need. Maybe it does. Maybe you find something that's in better shape than your car, and you can go ahead and maybe rely on this more. And then you might need to get a replacement sooner than you do with a new car. I mean, if you buy a new car, depending on the make, the model, how you drive it, I mean, you might be able to get 100, 200,000 miles out of it. You might be able to get 10 to 15 years of use. Whereas with a used car, you might get a lot less. Any questions so far? Anybody have anything that they want to ask or that wasn't, that you may want to go ahead and ask about?
I know Storm said in the chat, basic model vehicles could be on the cheaper option, like stick shifts are usually more cheaper than automatic cars. Nowadays, a lot of people do not know how to drive stick shift, and I am one of those people. So that's something that you can consider, you know, the older vehicles that you have to manually roll up the window. But I do see that those vehicles are usually cheaper. So that's something to consider.
That's a great point. And that's a great suggestion, Storm. I mean, basic models might not have all the bells and whistles, but it might be much more affordable for you. And as long as it's a reliable vehicle, I mean, that's what you're looking for. And then just what you were talking about, Alita, I think that's kind of interesting. So both my boys are adults. One does not know how to drive a manual transmission. The other one has always driven a manual transmission. And one of the things that he always kind of brags about is the fact that no one can steal his car. That's the way he feels, because most people don't know how to drive a manual transmission anymore. And so because of that, he thinks his car is less of a target for a theft than one that has an automatic transmission. So it's just kind of interesting, some of these things, but it is something to keep in mind, and it could lower your costs on some vehicles. I know that one of the things that's an advantage is your gas mileage is better with a manual transmission. So that's a plus as well. So that's something else to keep in mind, especially as high as the cost for gasoline has gotten. So, yeah.
I need to learn.
We'll find a way to get you some lessons, Alita. All right, so let's talk about leasing. And so with the lease, the difference is you don't buy the car, you're kind of renting it. And the lease gives you certain advantages. Some people buy leased vehicles and they get a new one every few years. They don't have to worry about going through the process of selling the old car. They don't have to worry about some of the things that you have with the new vehicle. You can get a lower monthly payment than you can with the loan because you're not paying for the full vehicle price. And some of the upfront costs are less than it would be for you to save up that money for a large down payment. So there's pluses to having a leased vehicle. The disadvantages are things like the vehicle doesn't belong to you, so it's not an asset. And to me, that's kind of one of those things where, I mean, a car generally has some value. So when you do sell it, you're going to get some money for it, but it's not an appreciating asset. I mean, if you buy a home, the idea, the hope is that as home prices go up, you're going to make money off your home purchase. Buying a car, unless it's some kind of a collector's vehicle or something that's unique, is not going to increase in value after you've driven it for 5 years or 10 years or whatever period of time you've had it. It can also be hard to get out of the contract. There's probably an early termination fee if you go ahead and turn the car back in. You can't sell it. I mean, it's not your car, so you have to go ahead and give it back to the dealership. And there are also extra fees involved to do things like, for instance, you drive it too many miles. Usually there's a limit. It could be 10,000, it could be 15,000 miles. It might be higher, but in general, that's usually the numbers that I see thrown around. And so if you're driving a car a lot of miles, this might not help you. And if you return the car in poor condition, you're also going to have fees that you're going to pay for that vehicle as well. And then last thing is it's difficult to make changes. If you want to go ahead and change out the car, you can't just sell it. You're going to have to go ahead and return it. And then you have to make a decision. Do you buy out the lease, which means you pay the money to go ahead and purchase the car, or do you go ahead and turn it in and you start the whole process again? For some people that works, but it might not be the right fit for you in your situation. So
if I can stop you really quick, because we did
sure.
get a question in the chat. The question was, is financing a vehicle considered an asset? And when you're financing a vehicle, you don't own it. Therefore, it's not asset. It belongs to whoever it's helping you pay for it. So that could be the bank or whoever you're leasing it through.
Great point, Alita. I mean, and in some cases, especially if you borrowed a lot of money against whatever it is you purchased the car for, you might be upside down. I mean, and by that, I mean that you may owe more money on the car as soon as you drive it off the lot than what it's worth. And so if something happened to that car, you might actually owe money to the bank or the financial institution instead of, you know, being able to walk away from whatever happened. So that's a great point.
Yes. So once you're done financing the vehicle and you pay it off completely, then that vehicle is now your asset, even though it won't be worth as much as it was when you bought it.
And there are strategies you can use to go ahead and pay off the car quickly. I mean, the fact that you have a 5-year loan doesn't mean you have to have the car loan for 5 years. This may not be your situation, but I'll give you an example. I mean, for me, what I did is I bought 2 cars. a few years ago. And when I did, I got loans on both cars. What I set up was a separate account, like I talked about. Every month I had some money go into it, which was an automatic deposit. And then anything that I considered to be found money or a windfall, things like my tax refund, things like maybe just a gift check I got or something like that, I threw it into that account. After the end of the first year, I was able to go ahead and pay off one car. And after the end of the second year, I was able to pay off the second car. And that way I wasn't paying interest on these loans anymore. And both the cars, they're free and clear. So they're my assets, just like Alita was talking about. So I own them, I can sell them, and whatever money I make off of them is mine.
Yes. And we have another question as well. What is the difference between leasing a vehicle and renting a car?
Oh, so car rentals generally just for a short period of time. I mean, it might be as long as a month. They have rentals like that. A lease is going to be much less expensive. If you're going through a rental car company for a vehicle and getting it for 3 days or something like that, the daily rate is much higher than what it would be to get a lease set up for like 3 years or 4 years or something like that to go ahead and be driving a car from a dealership. So that's the difference with the cost. In both cases, you don't own the car, and someone is set up kind of a rental for you. But with the lease, it's longer term and it's less expensive.
Yes. And then we have another question. Will paying off a car loan early have a disadvantage? There are some or penalties. Yes. So there, depending on the lender, they could have fee if you pay it off early. So you just want to make sure that whoever you're financing with, you want to ask them, like, if I pay my car off early, will I have fees associated with that? Because sometimes they do. You want to add anything, Daniel?
No, that's exactly true. I mean, you just want to find out if there's a prepayment penalty if you pay off the car early. With leases, there's generally an early termination fee.
When leasing for a long time, can you own the vehicle? No. No, because when you're leasing, you're under contract, and usually in that contract, they're saying that you're going to give this vehicle back at a specified time, meaning you will never own that vehicle, even though you've been paying monthly under your lease agreement.
All right. So we're going to move into the credit section. I mean, your credit score affects your ability to get a loan, the interest rate charge, and things like that. Most commonly, credit scores run anywhere from 300 to 850. And there are even different types of models that people use when it comes to how they go ahead and calculate your credit. But so I'm going to go ahead and give it over to Alita. And do you want me to just move through the slides for you?
Yes, and before we do that, we have another question. What about a lease to buy? Now, these ones can be tricky.
But usually, yeah, you can have that kind of an option built in. In most cases, what's going to happen is the dealership is going to say, if you want the car, you can buy the car, but there's going to be a buyout price that you're going to have to go ahead and pay. And I don't know that if they were a great deal, most people wouldn't give back the cars like they do. In most cases, people give back the cars. So I don't know that that really favors you. You may love the car a lot, may want to keep it. And if that's the case, then it is worthwhile for you. But in most cases, it's not going to be a very favorable deal.
And Storm, you're raising your hand?
Yeah, I think the reason why I asked that, because I think some people get, and I kind of mentioned this in the chat too, is like, those leasing advertisements where they're like, 0 down, but like, the monthly payments are actually kind of large, or they might get kind of suckered in by some type of advertisement. And then and they're just kind of in a place where that works for them, but they have intentions of like wanting to own the vehicle. That's what I've seen with like friends and stuff in the past. It was kind of like a good deal in the moment, but sometimes those deals have some fine print, and it depends on the mileage, the down payment. That's something that I've really come to notice, because sometimes those leasing deals that they advertise are too good to be true.
Yeah, and not only that, but there's a lot of alternative alternative loan options that are not through a bank or a credit union. And I know a lot of people that get stuck in those as well. Either they're paying way too much monthly for their payment, or they're paying and paying and paying, and the interest not, their principal is still high. And so you want to definitely be very careful with that. And as we move into credit, that's what we're going to mainly focus on, because usually when people get stuck in those type of situations, it's because of credit, because they don't have a good enough credit score to be approved by a bank or a credit union. So they go to these other loan, what do you call them? I don't even know what to call them, places to try to get a vehicle. And so if that's the case for anyone on this call, we're going to talk about credit, and please ask any questions.
Yeah, I've met some people who were big on the leasing, and from what I've learned from that, because you kind of would think, why do people do that? Like, don't they want to own their car? And from what I've seen is the people who are big on the leasing, they value driving a new car over owning their vehicle.
Absolutely. I worked at Mercedes-Benz when I was in high school and in community college, and these are people that have money. Everyone, many of our customers were on lease, and that is because, one, they have the money, and they want to drive a new vehicle, and so if you have the resources to do it, then it can be really beneficial to you. But if you are like an everyday person, you need something that's reliable, something that you can use for work, to take your kids to school and do your everyday type of living, buying one vehicle is really what you're looking for. That's reliable, right? But yeah. And then I have another comment. Why would anyone want to lease rather than buy, right? Again, if you have the means and you like new and you like to change things out every few years, then people go for the lease.
The other reason that there are a lot of leases are sometimes people will use the car for work purposes or business purposes only. Some professions, they kind of value the prestige of having a new car because it's part of their image. And then because they use it for work, they can write the car off. Now, I don't know if that's still the case because the tax laws keep changing, but for the longest time, that's been a big part of it, is that you could write out that expense if that leased vehicle was only being used for work, even though on the way home from work, you're running by the grocery store, or doing personal errands or things like that. It's still a work asset. And so that's how you can go ahead and take a deduction for it.
Yep, the more you know, right? All right, so we can go ahead and move on into credit. All right, so what is your score made up of? How does this number come into play? We all get one, and there are certain things that they consider. So one is the types of credit that you use. So that is going to make up 10% of your score. So that is if you have a credit card, that's if you have a student loan, that's if you have any other loans or credit history. Next, and the biggest chunk, is your payment history. So are you making your payments on time, or are you late often? That could have a substantial effect on your overall credit score. Then we move to the amounts you owe. So what is your utilization? Are you consistently maxing out all of your credit lines? That makes up approximately 30%, if I'm reading the colors right. And then the length of your credit history. So this is where a lot of people kind of, when they're brand new, they're like, what do I do? Because I don't have any payment, I don't have any credit history. And that is just how long you've had credit. And I also want to say it is the average age of all of your credits. So if you got your first credit card a year ago, and then you recently applied for another credit card, your new age of your history is 6 months, because they go off of the average age. So this is another reason why you don't want to apply for so much credit, especially back to back. And then your new credit makes up 10% of your credit score. And I know we got something in the chat. What are credit purchases best for? Can you elaborate on that, Damon? What did you mean? What are credit purchases best for? Like expenses, like what should you buy on credit? Is that what you mean? Okay. Yeah. So it really depends on you, right? Some people, they will just, purchase like their groceries and then they pay it off right away. Some people will, get gas. So it really depends on you. But I would say don't spend it if you don't have it to pay, right? So if you're just kind of buying up everything and you actually don't have the money in your account to pay it off, that's when you want to be careful. But when you're just doing your everyday purchases like your groceries and your gas, but all of that stuff is already allocated within your budget, you know that you have the money, then you're all set. I don't think you need to worry. You do still want to be careful about your utilization though. And then how fast did you pay a purchase on credit card? That's a very good question to ask. So some people wait until they get their statement. So if you are the type of person that waits until you get your statement, that means that whatever's on that statement was reported to the credit bureaus. Meaning that even though you've just paid it off, to the credit bureaus, they're like, you still owe $600, even though your balance is now zero. So but you're not late. You paid it off on time. So it's not bad, but it still is going to take some time for them to report your new balance. Some other people, they pay off the purchases right when it posts. And if you do that, it keeps your balance at zero, meaning that once they report it, your balance is zero. And that also reflects on your credit utilization as positive. So it really depends. If you can pay it off right away, that's great. If you want to wait until you get your statement, that's fine too. As long as you pay it by the due date, that's one of the most important things. Daniel, Daisy, is there anything else you want to add to that?
So I'm a bad example for you. I use my credit card for almost everything. But the reason I do that is there's a couple of things. One is it could be safer because if I report fraud or some kind of a transaction that's wrong, usually it's really easy to get that reversed on your credit card statement. As long as you keep an eye on your statement, if you let it go a long time, the bank is going to make you pay for it. So there are limits to how much they can charge you, but you still end up losing money. The second thing is the cards I have all get me points. And in my case, the weird thing is to get me points, it takes it's a Verizon card. So it actually takes money away from my bill. It reduces the cost of my cell phone. So every month.
You're a bad example, Daniel, no.
Yeah. So see, these are all really bad examples. So here's the thing though. Once a month, every month, I make sure the payment's already paid. And you can go ahead and set up auto payments for this kind of stuff. But if you don't have the discipline to do this, do not do this. I mean, these are the types of things when like I said, I'm a bad example for two reasons. One is that I use my credit card all the time, but I make sure the balance is zero. I always pay it entirely off at the end of the month. And then the second thing is, when I was younger, when I was in college, I had a credit card and I'd let the bills sit on my desk and I'd let my, work, my finals and all my books pile up on top of it. And I wouldn't pay that thing for 60 days. And it's like, that's not a big deal. I'll just pay the late charge. And I didn't realize that I was ruining my credit. And so that's something that I had to kind of change and turn around. So that's just something to keep in mind. But if you do use your credit cards on a regular basis, or you do use credit, like for instance, buying a car, most people don't have the money to buy a car outright. So you have to borrow the money. Or buying a house is a great example. Generally, most people don't have enough money to buy a home with cash. There are certain things you have to buy with credit. Doing it and managing it well kind of goes back to what Alita was talking about, and it helps your credit score. And the higher your score, the cheaper it's going to be for, you know, costs and expenses. And I know Alita's going to talk about that, so I'll stop there. But so that's the only thing I'll add. See, sorry, you shouldn't have asked me these questions. I'm a bad example, like I said.
No, it's okay though. It's okay. So I hope that answered your question, Damon. So as long as you're on time, that's what really matters. But you could pay it off, you know, on your statement due date, or you can pay it off once the transaction posts. It really depends on you. The main difference is the reporting. You know, one will report that you have a balance, one will report that you do not have a balance, which can make your score fluctuate. All right, we can move forward. So what if your score is low and you're trying to buy a car, you're trying to purchase something? You have some options. One is to get a cosigner. For a lot of people, this is not easy to do. So this is why you want to improve your score. And then to do that, that means you have to make sure that you're paying your bills on time, paying down your existing debt, because that does play a role in if they're going to give you credit or not. Avoid taking out any additional debt, especially when you're getting ready to make a big purchase like a car or a home. If you have any collection accounts that are reflecting negatively on your credit, you want to look at paying those. And then keep all of your old accounts. So if you have had a credit card for 5 years, the last thing you want to do is close it, because there goes your history. And that's going to have a substantial impact on your credit. So if the card is active and it's in good standing, if you can keep it, keep it. So why does good credit matter? And I think that we already know why, right? You need credit for everything. You need credit for car loans, for mortgages. You can get credit cards and personal loans to consolidate any debt that you may have, make it into one payment, right? Credit can affect your insurance costs. It can affect your employment opportunities, because some jobs will check your credit. And if you have bad credit, that could determine whether or not you actually get the job or not. And then also housing, right? You got to pass a credit check. If you're not worthy, you're not going to get approved for that apartment or that home. And I see that a lot with people. So your credit report, you know, how do you get it? How do you know what's going on with it? Well, you have 3 different scores that are given to you by 3 different credit bureaus. And those credit bureaus are called Equifax, Experian, and TransUnion. And I want to mention again that they are separate. Some people think like, oh, you could just do one and that's it. No, you have 3 different scores, 3 different credit bureaus. And each of them will compile a report on you based on the information that they receive from the lender. So if you have a car loan, if you have a personal loan, if you have credit cards, doesn't matter if it's from a bank or if it's from a Forever 21, right? They're all reporting that information back to the credit bureaus, and the credit bureaus give you a number. Storm?
Oh, I can let you finish. I do have a question, but I can wait till after you finish this slide.
Okay, yeah. And so all of that information is used to create your score, and that's where it's from. So Storm, you can go ahead with your question.
Yes. So when it comes to credit reporting, there are many places that you can check it these days. It's quite easy. I think one of the most common places people might use is Credit Karma. And I've noticed personally, and this is, you know, just from my experience, my score on Credit Karma is significantly higher than my FICO. For, you know, just checking my own ego, I listen to focus on the lower one. But that is like, and I mean, a pretty big difference, like 30 or 50, like quite a difference. So is Credit Karma, is that number to be trusted? I know they're updated very differently. I know one's updated much more often than the other one, but I've noticed a huge difference there.
Yes. So Credit Karma is a third party, and they have their own metrics for determining what your credit score is going to be. So some people use it as a monitoring source, and I think that's okay, but you do not want to use that for like actual business. When you're trying to really figure out what's going on, you want to make sure that you're pulling directly from the source, and that source are these three credit bureaus, because they are going to be giving you the most accurate and up-to-date information. Because banks will offer you your credit score, and a lot of other third parties will offer you your credit score, but they use their own metrics, and those metrics can vary, right? And I'm blanking on the type of like the levels of metrics that each you have to use. But yes, that's where the variation comes in, because everyone is using their own scale. Daniel, do you happen to know the different metrics?
Well, so there's like 9 different algorithms. So there's all these mathematical formulas they use. Credit Karma uses, I think, the FICO 9. So it really doesn't show you what your score is going to be when you apply for credit, like for a car loan, or especially for a home loan, because most home lenders use, I think it's the FICO 2. So that can be different. The information that goes into it can be different. The information and the scores that you get from these 3 bureaus can be different, because each bureau might get different information. And so that's part of, the problem with these free scores that you get, or even the ones that the banks provide you, like the credit union. Our credit union provides you with one, and it's not the FICO 2. What you can do is, do you talk about freecreditreports.com? I can't remember in your slides.
Yeah,
you do. Okay. So the best thing you can do is just look at your credit history, look at the 3 bureaus, and you can go ahead and see what's on there and if there are any mistakes. And then you can go ahead and kind of figure out ways to improve your credit. The other thing that we do as a credit union, which if you belong to a credit union or some of the financial institutions, we actually provide services where we'll help and do an analysis and see where you can do and improve things you can do to improve your credit score. But Storm, to kind of answer what you're saying, I mean, yeah, it's good. It looks high. It's always good for the ego when you see a high credit score, but it may not be what you're going to be using when you get a loan. The best thing about it is what Alita just said, which is it's a good indicator. If that score drops all of a sudden, it's like something happened. And so I need to check my credit to find out, why did that score go down? Because those things are all kind of interrelated. It may not be the same score for the FICO 2 versus the FICO 9, but if they both go down, they'll both go down at the same time when something bad happens.
Yeah, I've noticed that Credit Karma is very, very popular. If the higher number is mine, I thought I would have got offered a much better interest rate on my car loan.
Exactly. And I mean, the thing about credit scores is that they're consistently fluctuating. They're always moving. You could pay down all of your debt, and then you're like, oh, my score only went up 2 points. What happened? So it's really a numbers game. But if you just stick to the general rules of paying your payments on time, keeping your utilization low, over time, your score will get better. And I mean, everyone tries to aim for that 850, but in reality, if you can get anywhere in the high 7s to 8s, like you're pretty much tapped out. You're going to get the best interest rates, whether or not you have an 850. And so this is where we move into the power of time again. When you do make a mistake, when you do miss a payment, that kind of stuff stays on your report for a very long time. One missed payment, 7 years, it's going to reflect in your credit report. You have a collection account, 7 years. If you file for bankruptcy, it can stay on your report from anywhere from 7 years to 10 years, depending on the type of bankruptcy it is, right? Any hard inquiries, so that means anytime you apply for a loan or a credit card, whether you get approved or not, it will stay on your report for 2 years before it falls off. So this is, one of the reasons why we want to get information in front of people before they start making decisions on their credit, because once you make that mistake, you spend years recovering from it. And of course, any positive information will stay on your report indefinitely. So if you are, trying to figure out where do I start, how do I get credit, how do I create my credit history, or if you're starting over and you're trying to reestablish and increase your credit score, there are options. And so one is to repay any of your old debts. Because once you pay, then that will reflect positively on your credit, right? And make any settlements that are necessary. But one of the ones that we talk about the most is to get a secured credit card. What is a secured credit card? It's a credit card, but you have to provide the collateral. And collateral is, in case you do not pay. So most secured cards will require a deposit of about $500 to open the credit line. So that means that you have to give the financial institution that $500. From there, you will now have a credit line. So you can make purchases with your credit card, and you want to make sure that you are treating it just like you would an unsecured line, because regardless of them holding your money, they are reporting that information. So if you miss a payment, they're reporting that to the credit bureaus. You can be like, oh, well, you have the money, I made a deposit. Like, why is it such a big deal? It is because, they're holding you responsible. You're saying that you want credit, you want to reestablish credit, so you need to be responsible. You can also get a co-signer for any loans or credit cards. You can be an authorized user on someone else's credit card. And you can also, you want to make sure that you are keeping up to date with your credit reports. And one of the things that Daisy and I usually mention before we talk about the different options that you have is you want to make sure that you're actually checking your credit prior to applying for something, because you could have, derogatory marks on your credit report and not even know about it. A lot of people do not check their reports annually. And so if you are one of those people, make sure that you utilize, thank you, annualcreditreport.com. You have access to each credit bureau. You can get a report once a year. So you should be able to pull 3 reports a year, one from each bureau. And we recommend checking this before you apply for any loans or any credit cards, just in case that there's something derogatory on there. You can address that ahead of time and better your chances of being approved. Did I miss anything?
No, Alita, I think you covered it all. But I did include the link, and the first time you do it, it is kind of long, but it's only going to be done, once, and then you can check back again in another couple months. And like Alita said, it's free. Take advantage of these 3 you get throughout the year. Some people like to spread them out. For example, since you have those 3 different credit bureaus and you get one from each, some people choose, let's do it in January, then I'll check again in the summer, then I'll check again in December. That way you can avoid any, like if you're a victim of identity theft, you could get on it right away and get that stuff cleared out.
Yes, and I will say that there are other avenues that you can go through to check your credit, but they will charge you. So I would definitely utilize this free service before you begin accessing anything else. And another thing to keep in mind is to be aware of all of those ads and commercials that say we could fix your credit, don't worry about it. Because a lot of those credit repair companies legally cannot do anything, and they're just taking your money. If there is something wrong with your credit, you could fix it yourself. And you can do this by contacting the credit bureaus directly. You can write them a letter or you can call them, right? So there are different ways that you can report anything that is not accurate on your report. I think one of the things that kind of get people is that they want to just report everything, even the stuff that's actually true. And so when you get involved with these companies, one of their goals is to overwhelm the credit bureaus, because legally the credit bureaus have 30 days to respond to your request for. And so if they're unable to do that within the 30 days, they legally have to take that reported information off of your credit report until they can determine whether or not that information is accurate. So within this process, you may see a temporary increase in your score, but once they've had the time they've needed to investigate, if they find it's accurate, they will put it back on your report and your score will go back down. You will be out of money because you've trusted this repair place to help you, and they weren't able to. Does anyone have any questions about the credit repair process? Because it can be a tricky game and you're hearing these ads all the time.
So I just want to clarify. So I can repair my credit myself for free?
Yes, you can repair your own credit for free. And when we say repair, I want to use that word very lightly, because if you did make the mistakes in the past, then that's where you're just going to have the element of time that's going to help you repair, right? But if there is something where you're like, someone else must have taken my social or something, you can address those issues right away. You want to address those issues right away, so that it's easier for them to determine what's going on. All right.
Right.
Yeah.
So now we'll jump into financing terms. And I know I have 5 minutes, so I will go ahead and go through this quickly for you. Before you sign any loan documents, if you try and get an auto loan, make sure you understand what you're signing for. You want to know the amount that you're financing. Sometimes it's at the end of the process, you finally figure out exactly what the loan amount is, and that shouldn't happen. You should know right up front what the amount's going to be, what your payments are going to be, and that way, you'll know if this fits in your budget. Ask for an APR, and they have to by law provide that to you. And what that is an annual percentage rate. And what they do is they take any other fees or costs, roll them into the overall cost of the loan, and they recalculate it as a new interest rate. So that way, even if the interest rate may be like, let's say 4%, and they've got some fee in there that's for some special discount or something like that, or some special feature, and they charge you an additional $2,000. They have to include the $2,000 into your interest rate and come up with a different rate that you can go ahead and compare one loan to another. You need to ask if there are any penalties. We talked about that earlier. If you pay off early, what's the penalty? If you pay off, within the first year, is there anything significant that you need to be aware of? All of those are things that you want to make sure that you're aware of before you sign anything. There are lots of different types of financing sources. I know Alita touched on this earlier. I mean, you can get financing from your dealership. Often they're going to offer things like specials. You see those advertised all the time, 0% financing. But those types of rates for those models may only be available for certain cars, and it may mean that you can't negotiate the price on the car. And so that kind of limits your ability to go ahead and maybe get a better deal. You can get loans from credit unions or banks, any financial institution. Most of them will offer auto loans. And with that, you might get some flexibility, and you don't have to depend on the dealership and what they want to sell you. If you go to a dealership, it's kind of interesting. The first question they're going to ask you is, how much can you afford? Not how much you want to pay for the car, but how much can you afford? And then they work from there. Finally, the third source of financing for auto loans is a finance company. In some cases, these are subprime lenders. These are hard money lenders. What that means is, if you're credit challenged, they'll give you a loan, but they're going to give you a loan at a really high cost. And so that's where you have to be very careful, because you want to explore and exhaust all other ways of financing your car before you go to a finance company. In some cases, I mentioned this earlier, they might offer something like 0% financing, and that might not be the best deal. In some cases, maybe Toyota is offering some kind of a rebate if you buy a Corolla. If that's the case and you get the 0% financing, they may not give you that rebate. So those are things to be aware of. They may have a shorter loan. I see 0% financing a lot for 2-year loans. And that's going to mean it's going to be a much higher payment for you. And it's only available usually to people that have great credit histories, that have high credit scores and long established credit. So they may get you in to talk about a car that way, but that may not be what they end up offering you. First-time buyers, and if that's your case, it might be harder for you to find financing. Some lenders have what they call first-time buyer programs based on income. So instead of basing it on your credit, they're going to go ahead and say, well, you don't have any credit history. You may have a 0 score, which is possible. If that's the case, they may just look at your established income and say, okay, you have a history of income of this. In some cases, there may even be special programs, but they're going to go ahead and offer you a loan based on how much you make. The rates might be higher, but you want to ask the question, when can you refinance this loan? I'll give you a good example. Our credit union offers a first-time buyer program. What I usually tell people who are taking that advantage of that program is, you know what, in 6 months, make all your payments on time. So make 6 consecutive payments. And then at the end of that time, what I want you to do is come back to us, and then we can go ahead and refinance you, and you're no longer a first-time buyer. You've had an auto loan. So that gives you the opportunity to dramatically lower your rate. And then there are special lending programs that kind of mention this. In some cases, there may be loans that are based on just having worked for 2 months. And if that's your case, then you might be able to get a loan with some lenders so that you can go ahead and buy your first car, even though you don't have a long established employment record or established credit. Getting the best price. First of all, don't reveal too much. You don't want to go in there and be really excited about this car and be an easy mark. Do your homework around the car. Find out how much they're selling for. Research that. I mean, it's really easy with the internet around now. You can search around for different deals on different cars and see if maybe one dealership for the same car is offering a better price than another. And I've found that's true. You want to go at the right time. And by that, I don't mean at the right time, like end of month, because salespeople are going to try and talk to you and sell you a car no matter what time of the month it is. They have this line where they say, gee, if I get one more sale, I get this extra bonus, so I'm going to give you a great deal. That's not necessarily true. So go at the right time for you. And that's what you want to figure out. Like I mentioned before, there's a shortage of cars right now. It may be that it's better for you to wait 3 months instead of trying to buy a car at this time when there's a shortage. Don't let the salesperson talk into extras that you don't need, and be prepared to spend time negotiating. I want to tell you, don't be held hostage. And I really mean that sincerely. There are dealerships you'll walk into, they won't let you go. They want you to drive the car. They want you to see what it's like to be in a nice car or a new car. They want you to smell that new car and to be all enthusiastic and excited about it. And really, they're going to hold you there for hours. I mean, I've been in dealerships where I've waited for 6 hours looking at different cars. Don't buy late in the evening. If you do that, you're going to get tired. You're going to make a decision that maybe you're going to regret the next day. And you also won't see the car in the best light if you're doing this late at night. And don't let them keep you longer than you're comfortable with. You stay as long as you need to and tell them you'll come back. And they're not going to try and make you buy. They're going to try and keep you there, but don't let them do that. You need to leave when you have to. If it's a lease, negotiate it. You want to go ahead and go in and act like you're buying the car first, and then go ahead and come out and say, okay, I want a lease. What are my options? Because that way you'll get the lowest price in the car. Whereas with the lease, they're going to try and sell you the payment versus the value of the car. And the lease is based on the car value that they come up with. If you're selling your old car, you can usually get more if you sell yourself rather than trade into a dealership. It requires more work. Yes, it's harder. And there's some things you want to think about, like your safety. I know the last car I sold on my own using eBay I went ahead and sold it at a police station. I mean, I met the buyer at a police station, used their parking lot, and that way I felt like I was safe. It was a public place, and it's something that the police actually said I was welcome to go ahead and use their lot. Make sure you fix minor dings and scratches in the car, clean it inside and out, make sure it looks the best. And finally, for your legal rights, very quickly, There's a Truth in Lending Act. So the lender has to disclose all the terms of the loan. That means that right up front, you should know what the costs, the payments, the interest rate are all going to be. And if it changes on you, then you need to find out why. There's a Consumer Leasing Act. So the dealership that's leasing the car must clearly disclose all the terms of the lease. And finally, there's a lemon law, which entitles you to a new car refund if you buy a lemon. There's certain restrictions on that. In California, a car is presumed to be a lemon if within 18 months the vehicle is delivered to the buyer or 18,000 miles in the odometer. There are all kinds of problems with it, like you have multiple repair attempts and different things, and it's all laid out in the regulations. So that's it. We're 4 minutes over. So apologize, but we got pretty close. This is my contact information. Alita, you've shared your information and Daisy's information with the same group beforehand, right?